You know that feeling, right? You check your investments back in India, see those mutual funds ticking up nicely. It's great. But then maybe that little thought pops up. Okay, what happens tax-wise back in India when I actually sell these?
Huh?
Welcome to this deep dive. We're going to try and really unravel the capital gains tax rules specifically for NRIs selling mutual funds in India.
Yeah, it's a common question, and it can get complicated fast.
Exactly. The aim here is just to bring some clarity. And hey, if you find this useful as we go, please give us a like and hit subscribe for more. So just holding funds usually isn't a taxable event in India for NRIs.
Correct.
But the moment you sell, that's when Indian taxes can kick in and how much you owe. Well, it depends.
It really does. Essentially, any profit you make from selling your mutual fund units counts as a capital gain. And yes, that's taxable in India. To figure out how it's taxed, we first need to understand how India categorizes these funds for tax purposes. There are, broadly speaking, three main types.
Okay, three types. What should NRIs know about these categories?
Right. So first up, you've got your equity-oriented funds. Think funds mostly in stocks.
Got it.
Then there's a category called specified mutual funds. These are mainly debt-focused funds. And finally, there's a sort of catch-all category, just called other mutual funds.
Okay.
And the really crucial thing is the tax treatment is quite different for each.
Yeah.
They all have, defined criteria for what they invest in, which determines their category.
Right. Let's start with those equity-oriented funds then. If an NRI sells units from one of those, what are the tax rules?
Okay, for equity funds, the big factor is your holding period. How long did you own the units before selling? If you held them for 12 months or less, any gain is a short-term capital gain, or STCG.
Short term. Okay.
If you held them for more than 12 months, it's a long-term capital gain, LTCG. Now, the rates, they've changed recently, or rather, there's a key date.
Ah, yes. Tell us about that.
For STCG, so holding 12 months or less, if you sold before July 23rd, 2024, the tax rate was 15%. Plus, the applicable surcharge and the 4% health and education cess.
Yeah. 15%. Okay.
But for sales on or after July 23rd, 2024, that STCG rate jumps to 20%. Again, plus surcharge and cess.
20%. That's quite a bump.
It is. So that date, July 23rd, 2024, becomes pretty important for your calculations.
Definitely. And what about long-term gains on these equity funds, holding for more than a year?
Right, LTCG. There's an exemption threshold to keep in mind first. From financial year 2024-25, gains on listed shares and equity funds up to INR 1.25 lakh are exempt.
Okay, good to know. Above that.
Above that 1.25 lakh exemption, the tax rate also depends on that July 23rd date. Sales before July 23rd, 2024 are taxed at 10%. Importantly, this is without any indexation benefit. You can't adjust the purchase price for inflation, plus surcharge and cess, of course.
10%, no indexation. Got it.
For sales on or after July 23rd, 2024, that LTCG rate goes up to 12.50%. Still no indexation benefit, and you still add the surcharge and cess.
12.5%. Okay, so increases across the board for sales after that date for equity funds.
That's right, for both short-term and long-term gains.
Okay, clear enough for equity. Now, what about those specified mutual funds you mentioned, the debt-focused ones?
Ah, yes. These have a different, simpler rule in one sense, but with a key condition. For specified mutual funds, any profit you make on selling units is always treated as a short-term capital gain.
Always short-term, regardless of how long you held them.
Exactly. Doesn't matter if it was 6 months or 6 years. It's treated as STCG and taxed at your individual income tax slab rate. So whatever your applicable tax bracket is in India.
Okay. So potentially higher tax rates there depending on your slab.
Potentially, yes. But here's the crucial condition. This rule only applies to units you acquired, meaning bought, on or after April 1st, 2023.
So if you bought units in a specified mutual fund before April 1st, 2023.
Good question. If you bought them before that date, say March 31st, 2023 or earlier, then the tax rules that apply are the ones for the third category we mentioned, other mutual funds.
Okay, that's a really important distinction based on the purchase date. It bridges us nicely to that third category, other mutual funds. What are the rules there?
Right, the other category. Again, that July 23rd, 2024 date is key here. For sales on or after July 23rd, 2024. If you held the units for more than 24 months, so 2 years, the gain is long-term capital gain.
24 months for long-term here, not 12 like equity.
Correct. More than 24 months makes it LTCG, and the tax rate is 12.50% plus surcharge and cess. And again, importantly, without any indexation benefit.
12.5%, no indexation if held over 2 years.
Okay. If you hold for 24 months or less, it's short-term capital gain, STCG, and that's taxed as per your individual income tax slab rates.
Slab rates again for short term.
Yes. And just to complete the picture, for sales of these other funds before July 23rd, 2024, the older rules applied. For LTCG back then, which was holding over 36 months, by the way, you did get the benefit of indexation. So that benefit is gone now for sales post the cutoff date.
Right, so the loss of indexation benefit is a major change across the board for LTCG, it seems, after that July date.
It certainly is for other funds and also for equity funds where it wasn't available anyway recently. It simplifies calculations maybe, but potentially increases the taxable amount.
Makes sense. Now, this brings us to a really big question for our NRI listeners. We're talking about Indian taxes, but what about taxes in their country of residence? What role do double taxation avoidance agreements, DTAAs, play here?
The DTAAs, yes, this is absolutely critical for NRIs. The final tax treatment can be significantly influenced by the DTAA between India and the country where you are tax resident.
So these treaties could potentially offer some relief.
They could. Depending on the specific wording of the DTAA and potentially how the fund is structured, you might find that the treaty allocates the right to tax capital gains differently, maybe only to your country of residence.
Meaning potentially less or even no tax payable in India?
Potentially, yes. But, and this is a big but, it's highly dependent on the specific treaty. You cannot assume. Each DTA is different.
Are there any examples or trends we're seeing with DTAs and mutual funds?
Well, there have been some interesting rulings from India's Income Tax Appellate Tribunal, specifically looking at DTAAs with countries like the UAE, Singapore, and Switzerland. In certain cases, the tribunal ruled that mutual fund units should not be treated the same as shares under the specific wording of those treaties.
And the implication of that.
The implication in those specific cases was that the capital gains might only be taxable in the country of residence, not India.
That sounds potentially very beneficial.
It does, but there's a catch, or rather a complexity. Some experts worry this interpretation could lead to a situation where the gains aren't taxed anywhere, neither in India nor the residence country, if that country doesn't tax foreign capital gains.
Which kind of goes against the purpose of a DTA, right? They're meant to avoid double tax, not necessarily no tax.
Precisely. It highlights that these are very specific rulings based on treaty language and facts. They might not apply universally, and tax authorities might challenge such positions. It's definitely not a straightforward area.
So extreme caution and expert advice needed if you think a DTAA might apply.
Absolutely essential. And if you do want to claim benefits under a DTAA, there are requirements.
Like what?
Well, first, you obviously need to be a tax resident of the treaty partner country. You'll usually need to prove this by getting a tax residency certificate, a TRC, from that country's tax authorities.
Okay, the TRC.
And increasingly, you need to consider something called a principal purpose test, or PPT. It's being added to many treaties.
Principal purpose test, what's that about?
Basically, tax authorities will look at whether the main reason, or one of the main reasons, for structuring your affairs in a certain way was just to get the tax benefit from the treaty. If they believe that's the case, they can deny the treaty benefit.
So you need a genuine non-tax reason for your arrangements as well.
That's the idea. It adds another layer of scrutiny.
Wow. Okay, this has been incredibly helpful in mapping out the landscape. It's clear there are lots of moving parts, the type of fund, how long you hold it, those critical dates like April 1st, 2023 and July 23rd, 2024, and then the whole complex layer of DTAAs.
Exactly. We've covered the main principles, the framework. But your personal situation, your country of residence, the specific funds you hold, your purchase dates, all of that matters immensely.
So this is general guidance, not specific advice for anyone's portfolio.
Definitely not. We strongly recommend seeking personalized advice from a qualified tax expert or a legal professional who really understands NRI taxation and the relevant DTAAs. They can look at your specific circumstances.
And for listeners looking for that kind of specialized help with NRI capital gains on mutual funds?
Well, reaching out to a firm like Tax Acceler could be a very good step. They specialize in these kinds of cross-border tax issues for NRIs.
Tax Acceler.
And also, you could check out their website. They actually have an AI-powered chatbot that might help you explore some initial questions and get more information before you speak to an advisor.
An AI chatbot on the Tax Acceler site. That sounds like a useful starting point, too.
It could be. Gives you a bit more context.
Fantastic. Well, this has been a really insightful deep dive. Thank you.
My pleasure. Happy to help clarify things.
And to everyone listening, if this discussion helped you get a clearer picture of this complex topic, please do hit that like button and subscribe so you don't miss our future deep dives into important financial matters.